Hey everybody, happy hump day. It's right around a little after 12 o'clock on Wednesday. Hopefully the first half of your week was fantastic and you can finish strong going into the holiday weekend. One thing I want to bring up was something that Miss Dawn Debus brought up to me yesterday, and she was mentioning that she's starting to see that investors are coming into the market a little bit. Interest rates have brought them by. So what I wanted to do was talk a little bit about what interest rates, the effect that they have on pricing of producing properties, right? So if you take, basics. So income producing properties, the way that there is what's called a market cap rate or capitalization rate or rate of return, it all means the same thing for the purposes of this video. Basically, there's a desired cap rate in the area or what a ready, willing, and able buyer is willing to invest. For instance, up until recently, people were requiring between 6.75% and 7% rate of return. Why? Where does that number come from? Why isn't it 10? Why isn't it 4? Well, it has to do with two things. Number one, it has to do with your opportunity cost. So opportunity cost is defined as basically what else you can do with that same amount of money that you would invest in a property, right? So for instance, if you had $1 million and you're going to go invest it in a property, would it be better off to buy a property at 7% rate of return or 8% rate of return? Well, 10 times out of 10, someone's going to tell you 8% rate of return, and they would be right, all things considered equal. But that's the first part of the equation is your opportunity cost. So as you well know, you can't put your money in the bank and get 7% rate of return. So real estate is a lot more attractive. But the way sophisticated investors really look at things is they look at it from what are called the cost of funds. Now, cost of funds is nothing more than the APR on a mortgage, your annual percentage rate. So if you were to go, for in housing right now, you could probably get houses, I think, around 4.25%, 4.5%. Actually, I've heard stuff as low as 3.75%. A friend of mine refied not too long ago at right around 3%. When the pandemic really hit. But bottom line is residential rates are going to be a little bit lower than commercial rates. Right now, you can get a decent commercial loan at 4.5%, let's say. So a sophisticated investor is going to want what's called 2 points of spread, which is nothing more than you borrow your money here at 4.5% and you get a spread or a margin above what you borrowed it for, or else what's the point of borrowing money and putting it into a property and taking the risk if you're going to borrow it at 4% and buy something at 4%? You're doing it for practice. Nobody wants to do that. So in this case, most investors are going to want about 2 points of spread on their investments. So in this particular case, if you take a 4.5% cost of funds or APR on your mortgage, you're going to want about 6.5% rate of return. Now, if you contrast that with 9 months ago, last fall, the prime rate for commercial was about 5.5%. So back then, with this, applying the same metric or formula, people were requiring a 7.5% rate of return in order for an investment to make sense. So you can see why the market was a little tighter when you're looking at a 7.5% rate of return versus a 6.5% rate of return. So what does this mean for your clients and mine? What it means is when the interest rates go down in the market, it automatically makes the property more valuable. Why? If you remember from high school algebra, inverse relationships, one variable goes up, the other one goes down. In this case, the value of a property goes up when the cap rate goes down. So I'm going to give you the example of a property that produces $100,000 of net operating income, or NOI, or for the layman, profit, right? When you take in your rents, you pay out your operating expenses, you're left over with profit, $100,000 of profit a year, right? So that property at a 6% rate of return, so if you could borrow money at 4%, get a 2-point spread or margin above your cost of funds, that property would be worth $1.666 million to an investor at a 6% rate of return. Now, let's tweak that and look at, okay, if the rates were to go up and they were to go from 4% to 5%, what effect is that going to have on the value of property? Any guesses? Karen, any guesses? What's going to happen? Well, if you apply a 7% rate of return, or 1% higher than it was before, okay, it's going to take that same property that was worth $1,666,000 and it drops it down to $1,428,000. So 1 percentage point of cost of funds difference creates a huge difference in value. In this case, it's about $235,000 of value, and expressed as a percentage. 235 divided by this equals, whoops, give me a second, 235 divided by 1,428,000. Yeah, that's a 16% difference in the value of your property. So what you can take away from this lesson is this: if the banks are starting to move interest rates, the way you can talk to your clients and explain to them, say, listen, this is the effect it's going to have on your property. In this case, a 1% difference in interest rates created a 16% difference in value, okay? So it's very, very important for people to know this. So oftentimes the Fed doesn't move things, or rates don't move as aggressively as a 1% jump. The couple of half-point jumps we saw back when the coronavirus really hit back in March were unprecedented, frankly. But oftentimes they'll move it by 1/4 of a point. But even at that, 1/4 of a point difference is going to create a 4% difference in the value of a property. So in summary for today, basically, you're looking at cap rates are the return on investment. Okay, the net operating income is the gross income minus the operating expenses. And what you do is you take the net operating income, you divide it by the cap rate, and that's how you come up with the value of a building. So that $100,000 building divided by the 7% cap rate came out to $1,428,000. If interest rates go down, that same $100,000 divided by 6% on the bottom equals $1,666,000, a 16% difference. I hope that helps. If you have any questions, go ahead and fire them in the comments down below. And if you have any questions of other topics you'd like me to talk about, I'd be happy to do it for you. Hope you guys are having a great day. Enjoy. If you like the content you saw today, be sure to subscribe down below to my YouTube channel. I post videos like this weekly. I'll see you soon.